Hey guys, Rob Mitchell here. Thanks for joining me for this little mini webinar on day trading market structure secrets, broad concepts in market structure. These kinds of concepts that I'm going to show you in here can make a big difference in your trading because it helps you to understand how markets move. And I have some cool statistics associated with that can be helpful to you. First off, past performance is not necessarily indicative of future results. There's a risk of loss trading futures. Don't use the grocery money for trading. Don't use the grocery money for trading. So how you define and understand market structure, or price action as it's sometimes called, can have a huge beneficial impact on your trading if you understand a couple simple concepts. Can really save you years and years of messing around. So we're going to explore this in just simple broad stroke way here. So if we define market structure by the basic concept of the market going A, B, C, D in legs, going higher, higher, or lower, lower on price bars, then the measured move becomes a baseline concept for understanding market movement. Measured move is when you have two extensions going in the same direction that are of the same magnitude. Now, I'll cover that in just a second. So an A, B, C, D leg is one that is greater than one reversal bar, just for a matter of definition. In other words, it exceeds one full reversal bar. I'm going to show you a chart in a minute. We're going to cover that too. So if we further define it by allowing it to have a minimum amount of breathing room on each side, something that I would call, if you don't do that, the over literalization of the pattern, super important concept also, then we have created a pattern classification. Pattern classifications are super important. Why? Because when you see that they do the same thing over and over and over again, then you have a basis for understanding the market. And that's what I'm showing you here in this video. So if we then analyze one of the remaining categories from this rule set or pattern classification, that of the encompassing pattern, then we can know what percentage of the time the market does not have two or more legs. What percentage of the time does the market not have two legs? Market rarely does not have at least two legs. So this is super important for where you trade and how you trade, at a really high probability level. So understanding this gives us a known statistical profile for what to expect when we design trading systems or strategies, etc. So I'm going to do this we're going to look at a chart here in a minute using the Smart Super Renko from IndicatorSmart, and we're going to set the chart to a 5-10 setting. You'll see that at the top of the chart. And further, we're going to apply the Smart 1-2-3 indicator that I used to help me with the wave count, so I didn't have to spend hours figuring this out. So the result is per 100 legs of two or greater, A, B, C, D, about 5% of them created what's called an encompassing pattern. I'm going to show you that in a second, or a single leg. A single leg. And this means the general tendency of the market is for continuation at a really high probability level, really high. So for this market that we're doing this on, is crude oil. You do this in any market if you want to, and you're going to get roughly similar numbers. This means about one encompassing pattern per day on average for the day session. For the day session. Let's take a look. Over here on the left-hand side of the chart, this is Smart 1-2-3 going down. So got extensions going down, A, B, C, D. Now this is two continuation bars versus two continuation bars, and we would call that a measured move. They are equal. On this next one, this one's a little bit longer. So this one, A, B, C, D, this one is a little bit longer. You call that CD is greater than AB. To be literal about it. You have ones that are bigger than that in different scales, But here you got normal natural cycling. You go A, B, C, D going higher, and then you go A, B, C, D going lower, and you go A, B, C, D going lower, and A, B, C, D going lower, etc. And on this one, it reverses and comes back, and you get two legs there. Two legs there. And here it starts here again, and you get two legs going down, and you can see going down here on Smart 1, 2, 3, giving it that fudge factor of 5 ticks. And 1, 2, 3, 4, 5, 6, 7, 8, 9 cycles before it goes back up the other way. Now, natural cycling going back up here: A, B, C, D, E, F, and come all the way up and make 1, 2, 3 impulse legs. 1, 2, 3, and then reversing back down again. 1, 2, 3, going down. And then what happens over here? What happens over here? Notice that we go both sides of these in one run of continuation bars, and that's the encompassing pattern that we're talking about. That happens about 5% of the time, given this construct for the pattern classification. Yeah. About 5% of the time. Now, you'll also notice, if you go study lots and lots of encompassing patterns, that they're generally pretty big. They're generally pretty big. Why? Because this is a big trap to the traders that were short over in here. They all get stopped out over in here, and then it just keeps on running. So this is the general concept that we're dealing with here, is the encompassing pattern versus normal natural cycling. Those are the two things that we're comparing here. So using this concept, what do we know? Well, we know a few important things. We know what's normal or not. Is that encompassing patterns are not normal. Why? Because they only happen 5% of the time. It's 95% against or thereabouts. So that's not normal. Something that only happens 5% of the time is not normal, right? What else do we know? We also know that the continuation is most likely the result when the market's behaving normally. So once you get that encompassing pattern, you know you're not normal, and you may not get 2 legs or more following that. You got to wait for the market to renormalize. What else might we know? Well, it gives us a good idea that since encompassing patterns are fundamentally abnormal, we might expect the parties that were involved in making it happen, or that are present, are operating on a different level than the structured trading that is taking place. And then we might take it to yet another level and ask the question, who is doing this? Yeah, who is the party that is doing this? Because more often than not, if you study it, you'll find, if you've got the right kind of tools that I'm probably not going to cover in this video, but if you have the right kind of tools, you can identify who's doing that. And that's super important too, right? So what am I talking about on this slide right here? I'm talking about taking it to the next level. What kind of questions do I ask? What can I do with that information? It's always important when exploring new concepts such as these to ask the question, what can I do with this information? Because that alone can make a huge difference in your trading. Further, it is important to take concepts such as these and develop them more fully into actionable risk management systems using tools and a technology like the 4 quadrants method from IndicatorSmart.com. You can go over to IndicatorSmart.com, take a look there. I strongly recommend you do. And if you sign up there, you can get a free indicator, and you can also, for Ninjatrader, and you can also be advised when we're having different events and things like that. So I teach concepts like what I'm covering here, and more advanced technologies and trading secrets and tips and associated nuances in my trading room every day. So you can join us there if you want to learn more about this kind of stuff and how to create actionable trading systems based on actual repeatable technologies. And methods. So in today's video, we used Smart 1, 2, 3 from IndicatorSmart. We used the Smart Super Renko. What are other tools that could help us to identify parties on charts? I could use floor pivots. You could use VWAP. You could use the Smart volume profile and Smart support resistance tools to identify these 5 major parties And then in addition, there are other parties as well, generally not more than about seven or so different parties that make the movements happen on a chart. And it's super cool when you know who's doing what on the chart and whether or not they're pitted against one another or they're all working for the same thing. Yeah, super important. So, all right, guys, this is what I have for you today. Market structure secrets and all trading resources on what we discussed and the 4 quadrants and everything else can be found at IndicatorSmart.com. Like I said, opt in there, and you can also there's pages there for the trading rooms, and you can get over there and find out a little bit more about trading rooms. Yeah, thanks for joining me for this video, and good luck to you in your trading and taking your trading to another level using concepts like these. Yeah, thanks for joining me again, and we'll see you again on the next one.